The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York. Happy Halloween. I'm Katie Greifeld.
Happy Halloween. I'm David Gura. We are kicking off to the closing bell here in the U.S. I want to get a check of where markets stand here at the top of this, the 3 o'clock hour.
Here we go.
All of them here in green. The S&P 500 here up 0.3%. I should say the S&P on a track here for its longest string of monthly gains since 2021. Moving down to the NASDAQ 100, of course, quite tech heavy, and even longer stretch, poised here for the longest streak in 8 years. Keeping an eye here on the VIX at a kind of quiescent level, to quote our friend Tom Keene, here around 17. And NVIDIA is a stock that I've been watching over the course of the week, beginning with my time in Washington, where I was covering On Balance of Power. Of course, Jensen Huang was there announcing new partnerships. That was a theme through the course of this week as he made his way from Washington to South Korea and announced even more partnerships for that company. Of course, looking ahead to NVIDIA reporting earnings, Katie, in a couple of weeks, on November the 19th, if I'm not mistaken.
You probably are right, but at least for right now, it's October 31st, it's Halloween, it's a Friday, and it's trick-or-treat on Wall Street. With the magic of AI trying its best to cast a spell on those bulls, one spot in the markets that looks relatively bewitching is the Magnificent Seven, getting a boost thanks to earnings from Amazon and Apple. The Bloomberg measure tracking those stocks, it's actually poised for its longest monthly run since 2023. In fact, all the major averages looking to close out the month in the green, even as equity traders have had to come to terms with trade risks, government shutdown, and elevated valuations. The Treasury market, I'll point out, though, also set for a month of gains, even as momentum waned this week following Fed Chair Jerome Powell's comments that a December rate cut is not certain. Now, since the meltdown in April, the S&P 500 has soared, and it's on pace, actually, for its longest monthly streak of gains since 2021, while the NASDAQ 100 is on track for its longest streak in 8 years, all thanks to AI bullishness.
People realize that AI is going to be a defining trend, probably for the next 5, 10, 20 years. There's definitely sustainability and durability there.
And that AI equity leadership ain't budging for the time being. That is a direct quote from Bank of America strategist Michael Hartnett. But with such elevated valuations, Hartnett suggests that gold and China stocks are actually the best boom or bubble hedges, David Gura.
I am amused thinking of Michael Hartnett saying ain't.
Not me.
Not you, not your language. It's Michael Hartnett's, of course, the guy who coined the Magnificent Seven name. Give a lot of credit to him for that. Sticking with the AI bullishness, looking here at Amazon, on track, as you see on this chart here, for its largest single-day market cap gain in history. There was some concern about Amazon. You will remember just a few weeks ago, there was the outage. There was a lot of concern over, is it losing ground to Microsoft and to Google? Evidently not the case. Again, looking at that earnings report from Amazon, Katie, seeing it really on track when it comes to the Amazon Web Services business, providing so much of the profits that company just reported, and looking at digital advertising revenue as well. This company doing pretty well, and you see it reflected there in how its stock has performed today. Absolutely.
Well, let's keep this conversation going now with Kathryn Rooney Vera. She, of course, is chief strategist over at Stonex Group. And Kathryn, it's great to have you with us, of course, on the final trading day of October, because as I outlined in that wall walk, of course, there has been a lot that's happened this month. But let's start, of course, with what is most recent, and that is big tech earnings. We ran through a lot of them so far this week. And I'm curious, from what you saw, from the numbers and the commentary that you heard from these companies, do you think that's enough to keep the momentum going?
Well, look, I think that this is a sustainable trend going forward, but we have to discern between the enablers and the users and those that are just part of this arms race of AI and spend now, profits later. I think this is something that we want to be invested in, and that's what we're telling our clients. Valuations are elevated, but they're sustainable if we get EPS growth holding and rates remain stable. So I do think we want to be in the trade with the builders behind AI, semiconductors, cloud networking, power infrastructure. But we want to favor those that are cash generators, not the ones that are cash flow negative or investing without utility of AI. So that's where we're looking for value.
That's where you're looking for value. I mean, if you broaden your aperture a little bit and you take a look outside of the tech stack, talk us through the opportunities there. I mean, is there anything that doesn't touch AI that you feel really strong conviction on?
Well, having background in emerging markets, I love some of the emerging names. One of my biggest picks, and you can also always get alpha outside of the United States, but one of my best picks this year has been Argentina. It's been phenomenal. It's been, a triple digit almost in some instances return. So I think that you can find some value elsewhere, especially when you have the VIX so low and valuations so extended. Yes, we can get a melt up, and I think that's generally consensus that earnings are doing well and the S&P is going to continue to move higher. But there's other places that we can add exposure. I named one, Katie, but also U.S. cyclicals in construction, in electrical equipment, in industrial automation. All of these areas, I think, and if you consider energy and the big wall that we're about to hit with regard to electricity and energy capacity with this AI boom, I think those are areas here in the United States that we can look at, because electricity demand is absolutely surging and it will continue to, given this AI boom.
Kathryn, I hear you pointing out the fact that we have AI kind of bleeding into these other sectors and hard to look at anything exclusive of the growth that we're seeing in AI. Where are we in the AI story as you kind of find your way through this, as we all are? It's evolved very quickly. Your sense of where we are in light of the earnings that we got this week?
Well, Microsoft spent $35 billion last quarter. Alphabet is planning $90 billion next year. I think we're in the spend mode. Meta raised $72 billion. Amazon's investing in its web services like crazy. There are going to be, David, winners and losers here. And I think those companies that are investing not only in, the infrastructure, but those that are actually deploying AI, and that's a small fraction of corporate America, those that are deploying AI, I think are going to, where we see the productivity, because at the end of the day, this investment has to yield results, because right now we're kind of in spend mode, as I said before, profits later, but we have to at some point see the money here. And I think that's where the next leg is going to, manifest itself.
I was thinking of Michael Hartnett, who Katie quoted just a moment ago. And again, he kind of came up with this notion of us having a Magnificent Seven. And over these last many months has really sounded the alarm about a narrowing market, a lack of breadth in the market. And I'm curious if that's something that you likewise are concerned about, and what the indications are that you're looking for that we see some broadening out here in the broader market.
Well, it's pretty remarkable, David, if you look at the equally weighted S&P, how poorly it's done. So certainly I think the breadth shows that we're vulnerable here. I think one of the things that is not talked about that much is that if we continue to see, or if we start to see actually, a move higher of long rates, that's not going to be a positive for rate sensitive sectors such as tech. If we get an uptick in inflation expectations, that's not good either. So I do think there are some risks on the horizon. And unless and until we do actually see this broadening out that we've all been waiting for some extended period of time, then I think we do remain in a very pernicious, sort of vulnerable state. And that's why, David, I've been telling my investors, when you see the VIX as low as it has been and complacency at such high levels, I would recommend buying protective puts on the tech offering. Don't liquidate your position and realize full gains, but do protect it. It makes sense to me.
Yeah, the VIX right now trading with a 17 handle. We're talking about Michael Hartnett, and Kathryn, you said that you're not afraid to go outside the United States right now. You like Argentina in particular, but going back to Michael Hartnett's most recent note, calling out gold and Chinese equities as maybe a bit of a hedge here when it comes to the AI boom. I wonder how you feel about the China stock market right now, which has sharply outperformed the S&P 500 so far this year.
Yes, that was another one of our top picks coming into this year. We subsequently exited the position, but it has been something that I think you could tactically play. So yes, we are looking at opportunities in China. We're more looking at opportunities in Latin America because it is a primary beneficiary of the trade war and any escalation therein. We can talk about how the tariffs haven't had much impact as yet, but I think that's still yet to be seen. And one of the primary beneficiaries of any type of trade war is Latin America, precisely Brazil and Argentina actually, because they gain market share at the expense of China. So yeah, there are tactical opportunities, but I like the structural trades, and those are where my clients are most focused on the longer term over the next year or 3 years.
All right, Kathryn, great to get some time with you on this Friday. That is Kathryn Rooney Vera. She is Chief Market Strategist and Chief Economist over at the Stonex Group, helping us kick off the show on a very spooky Halloween. And coming up, GoDaddy shares on the move after logging solid results. The CEO joins us next to break down earnings and what's driving the company's momentum next.
Staying on results and conversations in the C-suite, Aon CEO is also going to be here to discuss the firm's latest quarterly report and how it is navigating a shifting landscape.
And we're rounding out the week with a strong finish. Wellington's Laura Kirk discusses what's next for private capital, as well as her run-up to the New York City Marathon this weekend as a board member of New York Roadrunners. All of that and more coming up. This is The Close on Bloomberg.
We see GoDaddy shares on the move up about 5% after the website domain provider boosted its full-year revenue guidance and beat analyst estimates on the top and bottom lines. Margin expansion and solid free cash flow helping drive the outperformance. Joining us on the heels of those results is GoDaddy CEO Aman Bhutani. Great to have you with us. And I want to start, we were talking a lot about this theme of AI, and throughout your call this morning, the results as I read them, really a through line for GoDaddy as well. How are you looking at AI? Let's start internally. We can talk about the external uses of it that you see as well. But how is it sort of reforming the way that you run the company?
Yeah, the AI transformation at GoDaddy really has three components. And let's start with the internal, like you said. You know, internally at GoDaddy, what we're really focused on are two pieces. One is generative AI, and the other is agentic AI. On generative AI, an example is, how we write code and using AI tools to write code. Well, we set a target for ourselves that by the end of this year, we wanted 70% of the code to be AI generated. So we wrote a tool that objectively calculates whether the code was written by AI or by a human. So nobody gets to sort of decide, the tool decides. This month, we are over 45%. So we're making very, very good progress in terms of generative AI. But what that allows us to do is to take a step back and look at the entire product lifecycle and say, beyond generative AI, how can we use agents to make every part of the process faster and really, really reduce cycle time? And that's going to allow us to bring products to market much, much faster, experiment with more ideas, have more shots on goal. I mean, a couple of the data points I shared that we launched a new Aero app builder. This is a vibe coding tool using generative AI. In that tool, 90% of the code is AI generated, 90%, 90. And that's not the only example. We launched a new ultra premium domains business. The aftermarket had a fantastic quarter in Q3. So we launched this new capability. In the past, it would never get prioritized because it'd be a relatively small project. But now, given the power of agents and being able to build websites quickly and using generative AI, a small team put it in market within a few weeks. And again, 90% of the code was written by AI. That's just fantastic.
Give me an example of sort of how this stands to change the way things work externally. So I think of myself, I wisely bought davidgura.com, but have done very little with it because I just don't have the bandwidth or time to do that. I imagine that AI is going to be able to build the whole thing for me at some point. Perhaps that's what I'm waiting for. But stepping back from me and my selfish reasons here, if I'm a company wanting to use AI through GoDaddy to kind of expand my business profile, what are you able to do? Give us a few sort of novel features.
So within a few weeks, and you can try it today too, but I feel very confident when we get out of beta on Aero.ai, I will be pinging you, and we will take your idea and build it, and AI will build it for you. In fact, my chief strategy officer, while we waited for the earnings call yesterday, said, you know what, I'd like to build an app to track my candy consumption. He's a big eater of sweets. And he just sat there and he used Aero.ai. There's a custom app builder in it. And he said, oh, I want a sweet tracker. Well, I want a nicer name. Oh, I want analytics. And the AI just kept creating page after page. And it's not just a prototype. He can literally go in and put in a custom suite and say, this is the suite I ate. And the site, the AI gives him all the categorization. It even adds the number of calories that particular suite has. Like Jared didn't have to add it himself. The tool actually did it. So I think there's a symbiotic relationship between AI making things easier and entrepreneurs bringing more ideas to life. When it gets easier to build websites, when it gets easier to build applications, when it gets easier to do more things in your business, thanks to agents, you're going to do more of them. And that means more ideas. And actually, the large language models will benefit as well because they rely on more websites to get more content and become smarter as well.
Well, it's very fitting we're talking so much about candy on Halloween. Aman, I do want to talk about code a little bit more. You mentioned by some measures, AI is responsible for 90% of your code. I think this taps into a broader existential question about AI. Do you think that there could be a day where it's responsible for 100%, or are you always going to need human oversight?
Yeah, we do still see for new projects at least 10% requiring human insight, but the models keep getting better, and our agentic capability around the model keeps getting better. So what you see happening is that developers are actually creating agents which can catch some of the issues and continue the work even when they're not paying attention. So I don't know about the 100%, but the 90% is a fantastic number. We're surprised to see it. We're so excited to see it. It's really going to open up our capability to bring more products to market much, much faster. But, I don't think we need 100, right? 90 is just amazing.
Really quickly before we let you go, we're up against the clock here. I do want to talk about your shares a little bit because I take a look at GoDaddy shares down about 32% year to date. That is with, of course, a pop today. What do you think that investors are missing about your story and the numbers that you're putting up?
Yeah, I think, none of the investors have a crystal ball, right? So they look at AI and they're not certain what AI means for GoDaddy or what it means for website businesses or domains businesses. And they're a little bit, I think, in the mode of let's wait and see. Well, what we see internally at GoDaddy is that agentic AI and the agentic open web can make a huge difference to our customers. So we're investing in it heavily while maintaining our margin guides. We've been able to put investment into AI and still hit massive margin growth over the last few years. And we're going to continue to do that. And as we do that, the last thing I'll leave you with is that GoDaddy has come forward with a fantastic innovation, which is called Agent Name Service. This is the infrastructure for agents on the open web. This does for agents what domains and SSL and DNS does. And it allows agents from one company to trust agents in another company, validate that those agents are what they say they are. And we're super excited about sort of bringing that new era of innovation on the open web, which is going to be based on agents and not just humans.
All right, Aman, got to leave it there. Great to get some time with you. That is GoDaddy CEO Aman Bhutani. We're up against the clock, truly, but you really did buy davidguro.com.
I did, yeah.
Wow.
Check it out after we figure it out with AI, which
I'm going to do that.
I have yet to do.
No, I'm going to do that during the commercial break. Coming up, Exxon and Chevron outperforming the street's estimates expectations after new oil field projects and acquisitions increase their crude outputs. We'll talk through the results next. This is The Close on Bloomberg. It's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And first up, Hershey. Piper Sandler upgrading the maker of Reese's and Twizzlers to neutral and holding their price target of $167. The analyst believes Hershey is in a sweet spot now that cost pressures from rising cocoa prices will moderate in 2026. Shares down marginally. Next in line, Roblox. Goldman Sachs is building up their call to a buy and upping their price target to $180 from $155. The firm sees, quote, strong platform momentum and expects increased investment in AI and technical infrastructure will reinforce Roblox's competitive position. Shares pretty much flat. And finally, Amazon. Morgan Stanley raising their price target to $315 from $300, maintaining their overweight recommendation. The analyst says that Amazon's better than expected third quarter results and forecasts are a reminder of how revisions outdo narratives in this AI winner/loser market. Shares up 10%. And those are some of our top calls. Now, staying on the topic of earnings, Exxon and Chevron both beating estimates in their results out today, in part thanks to oil production increases. Here to discuss is Jason Gabelman, Managing Director of Energy Equity Research over at TD Cowen. Great to have you with us. Let's start with Exxon because their cash flow estimate, it did meet or miss expectations. You could see that weigh on the shares in the early trade. We're back to positive just marginally here, Jason. When you read through these results, what sticks out to you?
Yeah, you mentioned the free cash flow miss. That was really due to one-time inorganic spend. They actually reduced their full-year organic CapEx budget to below the prior guidance range. So actually looking at organic spend, it's getting more efficient. And over time, looking forward, nothing's really changed for the stock. Still the best balance sheet in the peer group, still the lowest dividend break even. Oil price needed to cover the dividend in the peer group. Still the best suite of projects looking forward. And still, we think, executing at a level above peers.
Jason, help us look at it here in complement with Chevron. When you look at kind of their outlook, these two companies' outlooks, how is Chevron's different?
Yeah, Chevron is in a different place than Exxon. To some extent, they're moderating growth in a lot of their portfolio. If you look at what they're doing in the Permian, shale growth is somewhat plateauing there in the DJ Basin, in the Bakken. Their growth is really coming from an acquisition they recently acquired, which is the Guyana asset that Hess previously owned, which is an asset that Exxon is also in. So Chevron's story is much more about free cash flow inflection rather than underlying cash flow growth. A bit different than Exxon, which has a deeper set of project opportunities out through the decade and into the 2030s.
And I want to couch both of these companies in the global context right now, because you think about the supply and demand picture when it comes to global energy markets. When it comes to the crude market, it seems like there's this looming supply glut. And when you think about the prospects of both of these companies, the positions of both Exxon and Chevron, which do you think is better positioned at this moment to navigate some of those headwinds?
Yeah, as we mentioned, Exxon has a lower oil price needed to cover the dividend and a stronger balance sheet. So it's certainly better positioned to manage any near-term volatility in the oil price. But I'd be remiss to say, Chevron also is in a comfortable position from a balance sheet perspective. So we also think it could navigate any volatility in the near term. And the third thing I would mention is just that this is a much more orderly decline in oil prices than we've seen in 2020 due to COVID or in 2014 due to the OPEC adding a lot of supply to the market. So we think that once we get past this downturn in oil prices, it's going to create a much more positive and bullish oil price environment a few years out and into the later part of this decade.
Jason, very quickly here, sticking in the global context, and you mentioned Guyana, of course, Venezuela very much in focus as we stay in South America. In 30 seconds or so, how worried are you just about these near-term prospects? We had the president indicating he's going to make a decision on strikes here in the coming days.
Yeah, Venezuela is a consequential supplier of oil to the market. It produces about 900,000 barrels a day, which may sound small. It's less than 1% of global oil demand, but taking 1% of oil out of the market overnight could have material impacts to oil prices. With that said, OPEC still has a lot of spared capacity that it could add to the market to offset any supply disruptions. So it could cause some volatility in the immediate term if oil production is disrupted, but we think the market could really manage through that.
Jason, great to speak with you on this Friday. Jason Gabelman, Managing Director of Energy Equity Research at TD Cowen. And coming up, we're going to speak with Greg Case, the President and CEO at Aon, about that company's latest earnings release and the top 10 global risks they're watching out for. This is The Close on Bloomberg.
It's just about 3:30 p.m. in New York. This is the countdown to the close. I'm Katie Greifeld.
And I'm David Gura, looking at markets here as we approach the closing bell here in just a few minutes' time, half an hour's time. We see the markets higher today. Very much the story this week, that of big tech earnings.
Yeah, absolutely. And you think about today's action, it's been really touch and go, David Gura. At one point, we actually erased losses on the S&P 500. We're back, though, not quite at session highs. Amazon putting in a lot of work after earnings, now up about 11% so far on the day. And that is a big reason why you see the S&P 500 recovering into the close right now.
Going back to those earnings again, just struck by how well the web services part of that has done. We've talked an awful lot about AI. I imagine you do that every day on this show. I'm here just filling in and struck by how much you talk about AI and gets you up in the morning. Again, a huge theme here for Amazon in the course of those earnings today.
Yeah, and they're not the only earnings story out there.
That's very true. We had Aon popping on earnings after adjusted earnings per share for the third quarter beat estimates. We saw operating expenses of $3.18 billion, and the company expressing an optimistic tone here about the future, about the quarters and year ahead. Joining us now to discuss further is Greg Case, the President and CEO of Aon. Greg, thank you very much for being here, and let's talk a bit about the future prospects here, the quarter you've had, sort of what you're looking forward to here in the quarter to come.
Well, David and Katie, first of all, it's a pleasure to be here with you on the close. So thanks for the invitation. And listen, pleasure to talk about where we are. We had a very strong quarter, but really, David, to your question, it really represents what's going on in the world and what's going on in the world in terms of volatility. We're seeing more volatility than ever before. And we've talked about this around the drivers of that, around trade, technology, weather, workforce, all these things come together for clients in a way in which they really need to understand them more effectively so they can do something about it. And that's where Aon comes in. What we do is really help match capital with risk to reduce volatility in the world And you see that becoming more and more important every day. And the analytics we bring to the table make a difference. And they help clients sort of go from being concerned about ambiguity to really having certainty around how they build and grow their businesses.
Greg, you talked about data center growth on the call and help a layman understand sort of how your company is working with companies that are investing much more here in CapEx when it comes to building data centers.
Well, we certainly did, David. And as we brought it up, it actually brought more and more interest. For us, this is it's an unprecedented opportunity. When you think about the infrastructure build that's going to go around AI and the data centers around the world, starting in the US principally, but really globally, this is a level of spend we've never seen before, David, in terms of infrastructure spend. Call it 2 trillion plus in a very short period of time, and it gets bigger and bigger over time. And if you think about what we do, all the risk and volatility that comes with building, operating, and then continue to innovate around data centers is where we come into play. And we bring capital to bear to the extent we can actually help reduce the volatility and the risk as you build these. And then as you operate them, think about business interruption. This is going to be measured, business interruption in a data center is going to be measured in millions per minute. And so how do you actually help mitigate that risk and bring to bear capital so that they can be built more effectively, more cost effectively, and with more resilience? And so for the risk industry, it's a tremendous opportunity, but it's obviously a tremendous opportunity globally.
Well, let's talk about that a little bit more. You have a very interesting insight into some of the CapEx that we see funneled into the economy. Of course, you touch this in a different way than how we usually discuss on this program, and that has been the talk of the town, just how much money is being spent on the AI infrastructure build out and data centers. And from where you're sitting, I wonder what sense do you have of the sustainability of some of this demand?
Well, listen, Katie, really terrific in terms of sort of the direction you're going here, because it not only is the spend up front and how it's going to evolve over time, but literally how it's embedded in businesses, how it makes a difference to drive overall performance. That's going to be the arbiter of truth as it comes to sustainability. And we see it in our own business. What we're doing now to match capital with risk with analytics in ways no one has ever done in our industry is fundamentally grounded back into a use case around AI and how we've embedded AI into our analytics, how we've embedded AI into our service, and how we support clients. So from our standpoint, we're seeing it firsthand for Aon, but also with our clients. If you think about the ecosystem that goes into this building, each member of that ecosystem sees opportunity and sees application. And so, Katie, for us, the first step of this has already been monumental. We've already seen it happen in the economy now, but over the next 3 or 4 years, we see the demand profile here is absolutely tremendous.
So we'll keep a close eye on that storyline, especially as it relates to Aon. But let's talk a little bit about your recent M&A history, because I take a look at your $13 billion acquisition of NFP in April of last year, as I understand it. $13 billion, that's a lot of money for any deal in any industry, but especially when it comes to the industry that you're in and some of your peers. And I wonder, now that you're, a healthy amount of time out, how was that integration, and were there any surprises there in that process?
We brought in NFP last year, and it's been fantastic. It's really greater access to the very large $31 billion middle market in the U.S. been absolutely tremendous. And when we look at acquisitions, Katie, and bringing in capability, it really is around how we can strengthen what we do on behalf of clients. Again, and the idea of how we help them understand risks so that they can actually not be paralyzed by it, but see it as an opportunity to both defend the house and what they do, but also build the house. And NFP has been a tremendous example of that, bringing in capability that complements Aon, and Aon's risk analytics complements NFP. And we'll always look for opportunities to do this as we strengthen Aon's capability to support our clients around the world. This has just been, we had high expectations about NFP coming into Aon, and they've been exceeded. It's been absolutely fantastic.
Greg, could you situate the company's performance in kind of the broader macroeconomic backdrop here? This is a week when we had the Fed deciding to cut rates by another quarter point. Some of the uncertainty allayed about the path forward for the Fed, but you're in the insurance business, and I wonder sort of how you're thinking about the path forward here.
Well, David, you are hitting on exactly the right topic, which is when you think about all that's going on in the world, you ask yourself the question, is this contributing to greater volatility, greater uncertainty, or is it creating stabilization? And what we've seen over the last 24 months is really an increasing level of risk in the world. And, don't take our word for it. We actually do a survey every couple of years, the most comprehensive of its kind, called the Global Risk Management Survey. This is 3,000 companies and senior leaders around the world, and ask them, what's on your mind? And you see cyber at the top of that list, as you would expect, but geopolitical risk David, for the first time in 20 years, cracked into the top 10. So this is a level of uncertainty which is quite unique. And again, our role is how we help our clients understand that uncertainty in a way they can take action against it. Global supply chain, tariffs, all the things that come with that. So for us, we see ups and downs on a daily basis in terms of what that picture looks like, but overall, tremendous potential volatility in the world and helping our clients understand how they can mitigate it.
All right, Greg, that's probably a good place to leave it. Great to get some time with you on this Halloween Friday. That is Greg Case. He is president and CEO over at Aon. Meanwhile, you take a look at the market right now. We are less than 30 minutes until those closing bells on the month of October, a month in which the S&P 500 has gained about 2.6%. David, you think about all the different cross currents that have hit this market, hit risk appetite in the month that was, one of them being the government shutdown. You're not seeing it when it comes to this equity market.
It hasn't been manifest in the markets at all, and I think that's something that's really stymied a lot of lawmakers who might hope for a resolution to this shutdown. There hasn't been the kind of market pressure brought to bear that you've seen in past shutdowns. Of course, many of them have been in complement with fiscal cliffs. That's been another motivating factor, but having just spent time in Washington, Katie, it's striking how there really isn't any evident catalyst among lawmakers to get them back to the bargaining table, back to the negotiating table to find a way out here. Yeah,
you have to wonder at what point it will start to show up in markets, though, and maybe that will add a little bit of urgency to the discussions, maybe a little bit of a catalyst that it seems like has been lacking. But coming up, Amazon shares just in the stratosphere after earnings showed the fastest cloud growth in years. It's today's stock of the hour, and it's up next. This is The Close on Bloomberg. Amazon shares soaring on earnings, adding nearly $300 billion in market value and hitting their highest level on record. Cloud growth, of course, a key catalyst. Amazon's fastest, actually, since 2022. Let's discuss with Bloomberg's Norah Mulinda. So some needed good news for Amazon, especially when you think about prior to today, they had been lagging some of their peers in the Magnificent Seven on a year-to-date basis.
Absolutely. You've really been seeing Amazon trying to play catch-up when we think about it versus its other Mag 7 peers. I mean, if you saw Meta taking a very strong beating just yesterday. I mean, we're really seeing shares of Amazon on a tear up for their highest level on record. So clearly the street is taking this in, digesting it, and feels as though they clearly have a good, solid plan heading forward.
Talk to us a bit about the web services side of things. And I was just a couple of weeks ago, we had that outage and a lot of speculation they were falling behind Google and Microsoft. Obviously a hugely competitive space for them. What do today's numbers tell us just about how that race is going and sort of where they're positioned in it?
It seems to be going extremely well. I mean, this was really robust earnings that we saw, especially as we're thinking about what they got in terms of the metrics that we're seeing from their cloud unit here. And as you mentioned, they really are trying to compete with all the other people that are in the landscape here. So you are seeing them having some blowout results here, up 20% on revenue versus the previous year. So you really are seeing Wall Street clearly celebrating this as you're seeing Amazon being the main leader here in terms of performance here among the Mag 7 stocks more broadly.
So we're really psyched about cloud growth when it comes to Amazon. But you think about the business holistically. I mean, Amazon is sprawling, truly a modern day conglomerate. What are some of the other risks that might still be lurking out there?
So the other risks, I was looking at a William Blair note earlier today, and they were just talking about the fact that there could be a potential pullback in consumption. And if that's the case, of course, we're talking about the retailer, the regular consumer, you, me, and you, Katie, talking about the consumer, and if there is some sort of pullback there in consumption, since that is such an anchor for a lot of its other businesses, that of course could be a concern or a potential headwind here for Amazon.
Did we get any more color on sort of Amazon's plans for employment going forward? I mean, a big story here too has been the way that they look at AI and the way that its kind of business composition is going to change.
We just saw that story earlier this week about the fact that they were slashing so many jobs, and as we've really been talking about the broader discussion as to whether or not a lot of these tech workers are quite literally being replaced by what they actually worked on, right? AI. So that is something that still continues to be in discussion here for Amazon and a lot of its other competitors, that you are seeing starting to scale down on some of these roles and starting to lean more into AI to replace it.
Yeah, it's certainly a dystopian thought when you lay it out like that.
The Luddites were right.
They were. It would have been better to stay in the dark. But Norah, I mean, you bring up a little bit when it comes to the e-commerce side of Amazon. I do think it's interesting that the stock mostly trades on AWS and the like, but it feels like they're really taking over even more so than they already do when you think about their push really hard into grocery and food delivery.
I am an avid Amazon food delivery user. I'm not going to lie to you. But, I mean, you are seeing them really pushing into that space. And if you look even at Rufus, I mean, they have these AI chatbots that they're really trying to embed into the user experience. Rufus, Help Me Decide, that they talked about earlier. This is if shoppers are spending way too much time. Too indecisive, right? They're helping you narrow down what the options may be, and you can even select buttons, I believe, where if you want it to be cheaper, they'll give you options that show you cheaper landscapes, cheaper alternatives here, or the more expensive, higher-end products here they're also displaying here for you.
All right, Amazon shares on a tear right now. Great reporting from Bloomberg's Norah Mulinda. Meanwhile, we are about 15 minutes away until those closing bells. We're going to take you there with Victoria Fernandez. She is Chief Market Strategist over at Crossmark Global Investments. That conversation up next. This is The Close on Bloomberg.
There are some risks on the horizon, and unless and until we do actually see this broadening out that we've all been waiting for some extended period of time, then I think we do remain in a very pernicious, sort of vulnerable state.
That was Kathryn Rooney, Vera, Chief Market Strategist and Chief Economist over at the Stonex Group, kicking us off to the show. And David, it looks like we're going to have a green day to what's been a very green month.
It has been a very green month. And just looking at this board here, we see the S&P 500 here up about 0.5%, and NASDAQ 100. We talked a lot about tech over the course of the last hour or so. Again, that's been the theme of the week for me so far as I've been following all of this, and we see that up about 0.8% as well.
Yeah, absolutely. Meanwhile, you have a little bit of volatility coming in, if you can call it that, when you take a look at the VIX trading with a 17 handle. I'm glad you threw NVIDIA up there.
I threw it up there.
You threw it up there. NVIDIA up just a pedestrian 0.7%. Let's keep the conversation going now with Victoria Fernandez. She is Chief Market Strategist over at Crossmark Global Investments. Great to have you with us, Victoria. Happy Halloween. Let's talk about tech. As David said, it's been the story of the day. It's been the story of the week. It's really been the story of the past several years. You think about what we heard from the Magnificent Seven, the heavyweights in this market this week. Is it enough to sort of keep this momentum going through the end of 2025?
It sure does appear like it is, Katie. I mean, one of the things that everyone obviously was looking for in the earnings this week is what that CapEx number was going to look like. And are these companies going to be able to show some form of monetization, or at least the potential for monetization from this going forward? And, obviously we had Alphabet just knock it out of the park. They had a great earnings report. We saw Microsoft. I actually thought Microsoft's report was pretty good. I would have bought the stock a little bit on the weakness because I thought they had a pretty strong earnings show there. Meta suffered a little bit, but then we go to the big hitter, to Amazon. I was actually quite worried about Amazon because it's all around cloud growth. We were concerned that they were not going to have the cloud growth that the other Mag 7 names are having, but yet here they came, beating expectations, 20% growth. So I do think these companies are setting us up to continue to be a tailwind going into 2026.
Yeah, Amazon certainly showing that cloud growth. The shares are getting rewarded today. I want to go back to the point on CapEx, though, particularly when it pertains to Meta. As you mentioned, Meta punished in the markets when they came out with that big projection for just how much they're going to spend in 2026. And you think about the risk of overbuilding here, of overspending. It feels like Meta is the lens through which a lot of those concerns are being shown through right now.
Yeah, there's going to be a lot more scrutinization on this going forward. People are really going to want to know how that money is being put to work, what the return on investment is for that money. And when you have someone like Meta saying their costs are going to be notably higher and expenses are going to happen quicker than what they had anticipated, they're going to rise quicker. Those are concerns for people. And especially when you're not leading within that cloud space, like some of the other names are, when you're maybe trailing a little bit behind them in the modernization that you're having. And we know that they've had some losses in Reality Labs. That was a problem for them in their earnings. And so I think they probably started from a little bit of a different position there. But the rest of them surely are showing that this CapEx that they're going to put to work is going to continue to not only increase productivity, which helps all sorts of companies, it will help wages. And there's a strong multiplier from CapEx on the rest of the economy, which is why I think it'll it'll continue to be a push going forward.
Victoria, I'm going to guess that you were tracking at least a little bit the president's trip to Asia and the deals that were brokered on that trip, including the temporary truce with China. As you look at these big tech companies, and we can throw NVIDIA into the mix, how big a deal is it there is that at least a pause on the tensions that we've seen here for the last 6-7 months?
Yeah, David, I think it's interesting that you call it temporary, that it's a pause, because I think that's exactly it. We don't have any kind of permanent thing in place that really kind of lays out what things are going to be going forward. It is just a temporary pause. I think we've got about a year, like on the entity list, a little bit of movement on the rare earth metals and stuff that are there. So I'm not sure that the meeting itself is going to have a huge impact on the market. What I think it does is it just lets people take a little bit of sigh of relief and focus on something else. Right now, that's earnings. And so earnings will once again become the headline. It'll be what people are looking for. We have another big week next week. But I don't think we have any firm answers as it relates to China, as it relates to what China is going to mean for NVIDIA and some of the other tech stocks going forward. I just think it kind of kicks the can down the road a little bit, and that will once again come up once these negotiations start to ramp up again, and I believe that's going to be in April.
Victoria, Katie will forgive me for repurposing a question I used at the top of the show with Kathryn, but I asked her about breadth and how worried she is about the lack of breadth in this market. How are you thinking about it as we talk so much about AI, about big tech, about the hyperscalers, the fact that we haven't seen a lot of movement into other stocks here in recent weeks?
It's really the red flag for us. When we sit around our investment table, when we're talking to clients, that's our concern. I mean, let's look at Wednesday. We had more stocks make 20-day lows than we had make 20-day highs. So when that breadth is coming down, when you only have 13% of the S&P above its 200-day moving average, that tells us that you're in an environment where you don't want to chase the market. You want to let the market come to you a little bit. Yes, you have a handful of stocks that are doing really well, but the rest of the market is not participating. I do think the important thing to note with that is that even as some of the other elements are pulling back, consumer discretionary has pulled back a little bit over the last 6 weeks or so, it's not rotating into staples. We're not seeing staples really become leadership in this market, which means there's probably still a little bit more to go, but there is some uncertainty underneath.
Well, Victoria, when it comes to consumer staples, I'm glad you brought it up because it feels like it's gone through a little bit of an identity crisis. You would think the name staples implies that this is something that you want to own sort of defensively in your portfolio. Is that still the case when you think about the character of that sector? Is it still a defensive play or something else?
You know, there's different sectors now that kind of take on that defensive role. Some people would say tech is even a defensive play at this point in time because of the strength of their balance sheets that they have. But yes, because we have not seen that rotation where defensives are really coming out and taking leadership, because that probably means the market continues to move higher, maybe not in a straight line higher, but the trend will be higher. The staples names just aren't performing as well as you would expect them to when there's a lot of these warning signs that are out there. You're starting to see a little bit of life in healthcare, and that's probably the staple sector that is performing the best right now. It's starting to bottom, especially the biotech sector, but that's really it. It's not flowing through to the rest. So I would be a little cautious on getting too defensive in my portfolio, but still look at those companies that have strong earnings, good cash flows. Those are the places you want to park your money.
All right, Victoria, great to get some time with you. Again, happy Halloween. That is Victoria Fernandez. She is Chief Market Strategist over at Crossmark Global Investments, talking about a market that has come quite a way in not too short of a period of time, but that continues today and it continued in October. Now we are moving closer to that closing bell. Full market coverage right here on Bloomberg. It happens right now in our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
All right, we're about 2 minutes away from the end of the trading day. Katie Greifeld and David Gura in for Romaine Bostic, and here to help take us through the closing bell, it's a global simulcast. We're joined now by Carol Master and Tim Stanovic. We bring together all of our different our audiences across all of our different platforms, Carol. And what an interesting day it has been in this market. The S&P 500 all over the place, but certainly looks like we're going to finish in the green.
Yeah, we're looking at what, 6 months of gains, back-to-back gains. We haven't seen this in a few years. So the trend certainly has been a positive one. You know, coming off, go back to April, right, when the tariffs were announced and we saw kind of havoc in the financial markets, stocks selling off. We have had quite a bounce back since then.
Yeah, if you look at the NASDAQ 100, it's even a better picture. 7-month surge, could be the longest in 8 years. Big tech, we're seeing it today with Amazon and other companies helping propel the index higher.
Yeah, absolutely. And the story we've been talking about here over the course of the day, so much of the Amazon earnings that we got, you know, we saw great outperformance here in terms of cloud computing and its Amazon Web Services. Continues to be an AI story here, even amid the anxiety that we've seen here about how this story is progressing, and a lot of investors saying we have to see some proof in the pudding sometime soon.
Yeah, it's interesting to see Amazon get that trade back on track, because we know we ran into quite a lot of pain after we got some of the big tech earnings earlier in the week. I think about Meta, for example. A lot of anxiety. Once again, it feels like this comes around every couple of quarters about that ROI and just how much some of these companies are spending, Carol.
Yeah, Meta got some pain, some others did, but for Alphabet, it was like, okay, go ahead and spend. We're okay with that one.
Yeah, I guess it depends what type of company you are and what you're actually spending it on. Maybe for Meta, it's not quite as clear as it is for an Alphabet, but in any case, we're just seconds away from the market being officially closed for the week and for the month. The S&P 500 going to finish about 0.3% higher. We're taking a look at a level above 6,800 on your S&P. The NASDAQ also participating, up 0.6%. We still have the Dow Jones up there. You know, it doesn't really tell you much these days, but it also finished higher. Then you take a look at the small caps, the Russell 2000, also higher by about 0.5%.
You're such a Dow hater.
I know, but it's a price-weighted index.
What did the Dow ever do to you?
Doesn't make sense, Carol.
I know. I hear you. I hear it. Hey, listen, the S&P 500 for the month of October, folks, up 2.3%. NASDAQ 100, a gain of 4.8%. And this on a day, David, where we are seeing kind of an even split in the S&P 500. 260 names to the upside, 239 to the downside.
Yeah, you're right. It's roughly half and half. You're looking at consumer discretionary up about 4%, energy about 0.6%. You know, we talk so much about tech and information technology. I'm struck here just looking at the IMAP function here on the terminal. Information technology down actually about 0.3%.
All right. So let's go to kind of a mixture of red and green there. So let's go to some of the individual gainers. I had to talk about Amazon, your top gainer, or among your top gainers, certainly in the major indices today, finishing the day off its best levels, but still a gain of about 9.6%. Just quickly, you know who they are, e-commerce, cloud computing, one of the largest market cap companies out there. They did report third quarter results that beat expectations, with its Amazon Web Services business especially strong, and it also gave a positive forecast. Lots and lots of Wall Street analysts raising their price targets on the stock. I do think this is also maybe a record close on this name. We certainly did see a record intraday, and it looks like a record close also for Amazon on this Friday. Over to Netflix we go. That stock up about 2.7% in today's session, rallying. It announced a 10-for-1 stock split. That was after the close yesterday. Also, Netflix said to be actively exploring a bid for Warner Brothers studio and streaming businesses. This came out from Reuters, citing people with knowledge of the matter. Remember, though, Bloomberg News also has reported earlier that Netflix and both Comcast are weighing bids for parts of the company. So company at play, but Netflix was higher 2.7%, and Warner Brothers as that target up another 3.8% in today's session. And then I just wanted to throw First Solar. That's your number one gainer in the S&P 500 on this Friday, a gain of about 14%. Third quarter earnings per share beat estimates. Analysts viewing the company's full year narrowed guidance as better than feared, given the regulatory backdrop. We know the pushback that we've seen from the administration on solar and other alt energy. Several analysts also raising its price target, Tim, on the stock on this Friday.
Well, First Solar may be the best performer in the S&P 500 today. The worst performer, that goes to Dexcom, down 14.6%. This after the company cut its adjusted gross margin forecast for the full year. There were some analysts, though, who came out and said that 2026 growth outlook, I was a little cautious. They view it as conservative, and several firms saying they're going to use the weakness as a buying opportunity. And I think many would argue there was quite a bit of weakness today. Speaking of weakness, the worst day ever for Newell Brands, down 28% today. This is the parent company of Graco, Rubbermaid, Yankee Candle, Elmer's Glue, Sharpie, and more. The company cut its normalized earnings per share forecast for the full year, reported third quarter results that were below consensus. It's now trading at levels last seen in 2009. The company said it raised prices in response to tariffs, but competitors, they did not do the same, and that hurt its position in the market. And finally, more superlatives for Luminar Technology, ticker Laser, L-A-Z-R, the worst day ever for the company. Shares fell by more than 45%. It's now trading at its lowest level ever. It's a record low for the company. The automotive tech company makes LiDAR sensors and more. Raised a going concern warning. It says it received a subpoena from the SEC for documents in connection with an investigation it's conducting to determine if there has been a violation of federal securities laws. The company is exploring strategic alternatives, including a sale. Once again, shares down more than 45%.
Yeah, total wipeout in Laser. Let's get to the good stuff and go to the bond market. We've been talking about AI, of course. We had those magnificent 7 earnings, but you remember, we had a Fed decision this week. We had a Fed meeting in which the Fed chair said that a December hike or a rate cut rather in December, it's no sure thing. And that really has had an interesting impact on the bond market. Today, though, pretty quiet. The 10-year Treasury yield, I'm going to go ahead and call that unchanged. We're still well above 4%. We did briefly get below that earlier in the past week or so. But overall, pretty quiet when it comes to the bond market, Carol.
All right, let's get to, well, first of all, I just got to say, David Gore, are you trying to cause some problems? You want Tim to do the gainers?
Yeah, I thought maybe mix it up a little bit. Next time I fill in, if I'm invited back,
I've had people say, how come you never get
that.
People have said, how come you never get to do the gainers? And I say, I do them when Carol's gone.
Well, David Gura causing a ruckus in this chat, also calling out Tim Stanovic for submitting his decliners late. So.
That's a normal thing, David. I'm kind
of just squeezing them in
being
there.
outed here on air.
Well, you know.
Causing problems. All right, let's get to some stories that are on our radar. A lot of it has to do with Halloween. It is Halloween. Happy Halloween, everybody. This one caught Tim and my attention. Comes from our Business Week daily newsletter, and it has to do with an old bank that's downtown. It's been vacant. It played a pretty big role in the 1920s in terms of the excesses and then carelessness. It's a National City Bank of New York, and now a lot of folks are going there to celebrate Halloween.
Okay, there's a
This is
spooky
Tim.
teller.
I think this is Tim in your costume, right, Tim?
That's Carol.
Oh, sorry.
Ouch! All right, you get gainers next time.
There's an undead cop who wanders the hall. The experience is decidedly hair-raising. There are killer clowns lurking in the vault.
That was a killer clown.
Yeah. Oh, that was the killer clown.
I think so.
I don't know. This seems pretty cool. This is like very Bloomberg, right? It's Halloween meets finance meets, a little bit of banking history.
Boy, Tim, do I have a story for you.
Okay, I'm waiting.
The story that we are bringing to the table is about Halloween, but also AI. There's a haunted house owner, a real estate developer. His name is Derek Strine. He wants to turn the nearly 130-acre grounds of the former Pennhurst Asylum into a world-class data center. So as I understand it, it is a haunted house currently, but look at all that land, that square footage. Why not turn that into a data center? They're very hot right now.
Just fascinating, this story. 120 people work there on the holidays. It's like a successful haunted house, yet not successful enough, it seems. He's already spent, I think, millions of dollars, Katie, kind of lining it up to get more electricity, make it into the data center that he hopes it is. I guess make it more useful year-round? I don't know.
Well,
I feel sad
true.
about it.
It is a seasonal business, I suppose. We'll have to check in with him this time next Halloween.
Does anybody hear a bubble bust?
Well, is there anything more emblematic of our times than a transition such as this?
Yeah.
I don't know if they can get the power. I know he's trying to get the electricity up and running, but if you can get the power, why not?
130 acres. I mean, that's a lot of haunted house to get through.
A lot.
Well, I don't know. Maybe it's restricted just to the main asylum complex.
A lot of questions.
Kind of crazy.
Get him on the show.
Really important before we go, costumes, Katie?
I'm going to be a cat. I actually have some cat ears over there, but
that is
I am
surprising.
not allowed to wear them on air, as you might imagine.
That's a shame. David?
I have no costume, but I have 3 children. I'll be squiring around the neighborhood tonight. Maybe I'll see Tim.
Brooklyn Dads?
Yeah, I think you probably will.
Yeah.
I'll be about 45 minutes behind you.
Okay.
But what's your costume, Tim?
Oh, no costume either. I'm just
okay, very cool.
holding the kids' hands and we're going trick-or-treating.
Carol, help me out. What's your costume?
He's going as an anchorman. No costume either.
Oh, my God.
Katie, we're grown-ups.
I guess. Oh. Jeez,
I'm going home to pizza and wine, kids. That's what I'm doing.
That sounds pretty good.
All right, that's a wrap. Have a good and safe evening and a good and safe Halloween across platform, radio, TV, YouTube, Bloomberg Originals. David and Katie continuing there on the close on TV, and Tim and I continuing right here on Bloomberg Business Week Daily.
All right, coming up, a discussion on the asset-backed finance market and the real estate environment with Michael Nierenberg. He is CEO over at Rithm Capital. That conversation up next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. David Gura is off trick-or-treating. Romaine Bostic is off, so I'm all alone for the next hour. Let's take a look at how markets closed on the day. The S&P 500 finishing out the week, the month with a gain of about 0.3% if you round up, if you're feeling generous. A lot of that strength came from big tech, and you can see that in the NASDAQ 100, higher by about 0.5% on this Friday. We know Amazon had a fantastic day after a really strong showing when it comes to cloud growth yesterday. So big day for the tech stocks. The bond market, not so much. A really quiet day overall, as evidenced by the U.S. 10-year yield currently flat, basically. But we know there's been a lot of volatility there, a lot of volatility in the stock market. The VIX now trading with a 17 handle, very up slightly on the day. So that's the equity market, the bond market. Let's get to our weekly ETF roundup. Wall Street riding the era of American state capitalism. You have Round Hill Financial submitting paperwork to launch an ETF that would reflect the U.S. government's investment strategy. Now, the proposed ticker is USGA. The fees are not yet listed. This is really interesting because we know the U.S. government has been buying up stakes in different companies, Intel on that list. Let's discuss with Bloomberg's Isabelle Lee. So we don't know, of course, the actual holdings of this ETF yet. It is not yet launched, but what could we expect when it comes to what the portfolio will actually look like?
So we don't know what the holdings are, but this ETF in itself is very interesting. So you and I sit next to each other, and when this filing dropped yesterday, we knew that we had to write about it because it's a great example of really how this era of American state capitalism is translating into markets, and that's as Washington really takes a playbook off of Wall Street. And so the goal is to really replicate the U.S. government's capital allocation strategy. So if approved by the SEC, which currently is now affected by the shutdown, you can think of this ETF as turning a political view into an investable strategy, which is very interesting as we know this administration really muscles itself into Wall Street.
Absolutely. This is just the latest example because it feels like we've gotten other flavors of ETFs that try to do something similar. What I keep thinking about when it comes to this ETF is the example of Intel, because depending on when this ETF actually buys a stake, actually follows the government, you might miss the pop entirely. In the case of Intel, it was reported out in the media that the U.S. government was considering a stake. It didn't actually confirm that investment until later in the month. By that point, the stock had already rallied. What do we know about when it might actually be able to make these purchases?
So that's what's unclear, and that's a great point because the prospectus only said that it will invest in publicly reported asset allocation strategy. So what does publicly reported mean? Does it mean that when the deal is closed or when it's announced or when there's speculation? And we know this, we cover in our team the S&P 500 rebalance, for instance, and we know that the stock pops when it's announced, whether it's added or deleted, not when it's actually added or deleted. So you may miss the outperformance, which you brought a great point to Intel. And I mean, the government's reported stakes range from Intel, US Steel, Trilogy Metals, and if you listen to what the officials are saying around President Donald Trump, the list may keep on growing. So kind of great timing for this ETF to, if approved by the government.
Yeah, absolutely. Of course, the SEC being open, I don't know, it might help in terms of getting this off the ground. Isabelle, great reporting as always. That is Bloomberg's Isabelle Lee. And for more ETF insights, be sure to check out my newsletter, ETF IQ. You can subscribe at Bloomberg.com/ETF IQ newsletter. I should be publishing today's edition or this week's edition fairly soon, but stay tuned on that one. In any case, October trading coming to an end, and that marks a big month in the real estate space. JP Morgan, of course, opening its new multi-billion-dollar headquarters. You also had SL Green striking a deal to buy Blackstone's Park Avenue Tower. And our next guest is betting big on the future of the office space with his firm, Rithm Capital, striking a deal to buy office landlord Paramount for $1.6 billion. Michael Nierenberg, he is the CEO of Rithm Capital. He joins me now on set. Great to see you, Michael.
Great to see you. Thanks for having me.
So let's talk about the office landscape. It sounds like we're telling less ghost stories about, of course, how office stands right now. For so long, it was, okay, commercial real estate, it looks pretty good, except for office. Has that storyline truly turned a corner?
You know, I think for us, we have avoided what I would say is the early, I'm not going to say demise, but the dislocation in office that goes back to the COVID days. We looked at this as an opportunity with no legacy, what I would say office in our company to jump in, take advantage of a situation where we're able to acquire 13 million square feet of office, A quality, A-type buildings in two of the gateway cities in the U.S., both New York and San Francisco. I think a lot of this has to do with replacement costs right now. Mm-hmm. When you look at this portfolio, we're acquiring assets or buildings, I should say, at a basis a little under $600 a square foot. When you look at the replacement cost, it's probably $2,500 to $3,000 a square foot for these very same type of buildings. So. We're super excited. We like to think of ourselves as more opportunistic investors, and being able to actually jump in on this portfolio and this company gets us real excited.
So we are talking days ahead of a big mayor's race when it comes to New York City, and there's wildly different views on what an Andrew Cuomo would mean for the city as it pertains specifically to real estate, and what a Zohran Mamdani administration would mean. So Mamdani, the front runner as it stands right now, how might that impact this sector in which you operate?
I think, when you think about concerns around Mamdani, I think there's a lot of concerns. If there are concerns, there's a lot of concerns, I should say, about him and a lot of his policies. When we look at the commercial real estate space, we feel real good about that. You're coming off what I think is the best leasing quarter for commercial real estate in New York City in well over 20 years. When you think about Mamdani, is it a quality of life issue? Is it around rent stabilized housing? We don't have any rent stabilized housing. I do think that's a sector that obviously is going to be under pressure to the extent that he does win the election. The quality of life stuff is something that continues to resonate with folks. How do we think about the police force? He did reaffirm that he's going to keep Jessica Tisch as police commissioner to the extent that he gets in. We look at it, and I live in New York City. We've had other mayors before. We had de Blasio. So, yeah, I mean, it's something to be concerned about. But I think as it relates to what we're doing here in the office space, I think we feel pretty confident that we'll be okay.
Right. It's good to context that, of course. You've been through political cycles. You've been through different administrations before. But just to drill down a little deeper, I mean, I was taking a look at your earnings call. You mentioned, as it pertains specifically to the Paramount portfolio, some of the things that you want to do is not only grow occupancy, but you also want to drive rents higher, that you take a look at the average rent. I think it's about $85 per foot. So, again, you think about the Mamdani campaign, you think about some of the things that you're saying in the earnings call about driving rents higher. You could see how the two might come into conflict.
Yeah, here I think this portfolio, when you think about average rents of $85 a foot, we're in the market as a firm. We have our, the Rithm brand, and then we have Sculptor as well. We have a need for about 100,000 square feet in New York City now for a new lease. When I look at, and we're in the market looking at every day, we're looking to see, where we're going to go. And the average rent for an A quality property is, well north of $85 a foot. Our space that we're in now is give or take about $150 a foot. Wow. You go to 9 West 57 where Sculptor is, the new ask there is going to be probably something towards $300 a foot. So you compare that, there is a lack of office space in New York City. And I just think, $85 a foot versus $300 a foot, there's something in the middle there, and that's going to help us drive rents.
Right, that gap can narrow there.
For sure.
Another comment that you made in your earnings call that caught my eye is that when it comes to AUM growth, you said something along the lines of you're not in that business of just trying to increase your AUM. And I was hoping you could put a little bit more color on that.
We want to grow AUM like every other asset manager, but we have to lead with performance first. When you sit down with an LP or you sit down with one of the wealth management firms, they don't need any more managers. Obviously there's Blackstone, Apollo, everybody has this large suite of products. When you look at us, we're earning our stripes. Right now we have $55 billion of third-party capital under management, or we're managing over $100 billion of assets. We have enough, but when I say we have enough, if we could lead with results and dealing with people, it's a people business. If we drive good results and we have a suite of products that suit the needs of LPs out there, we'll raise plenty of money.
All right, Michael, really appreciate the time on this Friday. That's probably a good place to leave it. That is Michael Nierenberg. He is the CEO of Rithm Capital Meanwhile, coming up, an asset manager racing to take advantage of the private market mania. We'll discuss Wellington's push into the private arena with Laura Kirk. She is Wellington's head of private capital formation. That conversation coming up next. This is The Close on Bloomberg. Welcome back to The Close. Wellington making a serious push into private markets, hedge funds, and retail. Now, after skirting the spotlight for its almost 100-year history, the trillion-dollar asset manager has changed its tune, spending big on hiring bulge bracket bankers, alternative asset professionals, and a public relations team. Joining us now is Wellington head of private capital formation, Laura Kirk, who is also a board member of New York Roadrunners, many of whom are gearing up right now for the New York City Marathon this Sunday. Laura, great to see you in person.
Yeah, thanks so much for having me. It's great to be here.
So we're going to talk about the marathon, but we should probably talk about private markets first, because as I mentioned, I mean, Wellington has been making this push. You think about Wellington, a lot of folks think about, you know, public equities, public bonds, but talk us through the strategy that Wellington is taking here and building up this platform.
Yeah, great. Well, thanks again for having me. It's really great to be here, as I said. So, you know, it's interesting. Maybe I thought I'd spend a little bit of time about how I got to know Wellington as an organization.
Yeah.
So I actually grew up, you know, prior to joining Wellington about a year ago, I spent about 15 years at Goldman Sachs, about 10 years of that in our manager selection business. I actually grew up on the public side, covering Wellington as a client. So like you, I got to know Wellington as an organization on the public side, covering long-only funds. It's been really interesting for me as a relative newcomer to Wellington to hear about Wellington's private platform and to basically share the story. I mean, Wellington has been actually in the private markets for about 10 years. I like to say we're a roughly 10-year-old business with inside a 100-year-old asset manager. And I think that's a really interesting way to phrase it, because it really gives us the agility of a relatively new business with inside the stability and kind of scale of a big, large asset manager. As you said, we manage over $1 trillion in assets across public fixed income, active equities, and alternatives.
And so, you know, you think about, like you said, it's sort of a startup within a much older company. 10 years is certainly not an insignificant amount of time, but I mean, where are you when it comes to truly building out your private capabilities, when it comes to, you know, spinning out and ramping up the platform?
Yeah, so, you know, it's funny. I mean, we started our first flagship strategy, our late stage growth strategy, I think really sits at the nexus of public and private investing and is a great example of the way that we leverage the breadth of the firm. So this is a strategy that invests in companies that are growing and are generally, but not always, on a path to public markets. And so that team really leverages the breadth of the firm in terms of those insights. As we expanded, we grew from that late stage strategy. We, on the venture side, kind of went earlier stage, expanding into sectors that were of expertise to us, in particular in biotech and then early stage venture. And then more recently, we've been building out our capabilities in private credit over the last several years, hiring several dedicated teams to execute on private credit strategies.
Well, let's talk about that a little bit more, because, you know, you mentioned you joined in 2024. There's certainly some new faces when it comes to your private teams. When it comes to adding headcount for these capabilities, is there still more room to grow here, or do you pretty much have the team in place?
I think there's a couple more hires that we're going to be making, but I would say, largely speaking, we have the team in place today, particularly in the private credit space, where we've brought on 3 different capabilities. It's, you know, I think Wellington offers a really phenomenal platform from which that we can hire. It's a firm that really values independent intellectual thought, and so the idea is to bring talent into the organization where they can execute on their craft, but really plug into a broader investment ecosystem that's really truly collaborative across both the public and the private side.
And I have about a minute left with you. I have to ask about the marathon. Of course, you're on the board of New York Roadrunners. I know that you're running on Sunday. In 30 seconds, what do the next 2 days look like for you?
Oh my gosh, thank you so much for asking. So yeah, the New York City Marathon is truly like the best day in the best city in the world. I can say this, you know, I'm a little bit biased because I did grow up here, and this is my 12th time running the marathon. Wow. But the next couple of days look like a lot of rest, a lot of, you know, carbo loading, a lot of liquids, and so it's just going to be a really, really great day, and I'm just so fortunate to be able to be part of it for the 12th year now. All
right, well, good luck on Sunday, of course. Eat your pasta, eat your bagels. That is Laura Kirk. She is Wellington's head of private capital formation, also a board member of New York Roadrunners, with the New York City Marathon coming up on Sunday. Much more conversations coming up ahead on The Close. This is Bloomberg. as we were just discussing, New York City gearing up for marathon weekend with more than 50,000 runners expected to hit the streets. Last year's event generating nearly $700 million, more than twice as much as in 2019. Now, as those athletes lace up, our very own Romain Bostic, he had an inside look at how the world's largest sportswear company is putting its best shoe forward once again.
In the heart of Western Oregon lies a 750,000 square foot plus complex. So secret, few are allowed past the lobby.
If you love sports and you love product, this is kind of Disneyland.
All told, more than 800 pieces of testing equipment under the roof of the LeBron James Innovation Center, home to the Nike Sport Research Lab.
This is the home to dreamers, creators, makers, engineers, some incredible teammates of ours who are all dreaming about serving elite athlete problems.
Yeah, what Nike as a brand is founded on, really at the core of our history and heritage, is listening to the voice of the athlete.
Amy Montaigne is the new president of the Nike brand. Phil McCartney is the new chief innovation, design, and product officer. They are two of the key players in CEO Elliott Hill's full court press to reinvigorate growth following former CEO John Donahoe's reign. It was a tenure that saw annual sales begin to drop in 2024.
We're going to obsess sports. I think that's been since Elliott returned. The reason that we start with elite athletes is when we solve those discerning problems, those milliseconds, micro millimeters, we can create products that then translate down for athletes every day all over the world.
Speaking of the everyday athlete, I put on my running shoes and geared up for an afternoon under the microscope of some of Nike's best researchers for a head-to-toe consultation. Nike's Chief Science Officer, Matt Nurse, providing some words of encouragement along the way.
So we have an expression, if you have a body, you're an athlete.
Yeah.
And a lot of what we learn from elite athletes does trickle down and help everybody, but a lot of what we learn from everyday athletes does trickle up. Honestly, today it's just a more modern, sophisticated incarnation of what Bill Bauman was doing in his lab, but allow more sports, more athletes, full speed, full motion, but we're solving the same problems, doing the same thing.
A little different this time around. Mounting pressure in the running space, under threat by competitors like On and Hoka.
It's fair to say that the distance between ourselves and our potential is a little bigger than the distance between ourselves and our competition.
What I believe and want for the Nike brand is for us to always remember our roots and to honor our founder, to really come in every single day obsessed with serving the athlete, listening to their needs, not only meeting their expectations, but taking them somewhere new. And when we do that, there is all the opportunity in the world for our future.
And those were some of Nike's key executives sitting down with our own Romain Bostic. And speaking of fitness, a new player is boosting their role in the space after raising $12 million in funding. Sweatpals, it's a digital platform that helps users find fitness classes, events, and much more. Their new investment will fuel national expansion and platform development. And here to talk about it is one of those investors, Andrew Chen. He is general partner over at Hay16Z Speedrun that operates, of course, under Andreessen Horowitz, and the founder and CEO at Sweatpals, Salar, Shahini. And it's great to have you both with us. Salar, I want to talk first with you and just set the groundwork here. I just explained, of course, what Sweatpals is, but in your own language, what exactly is this app trying to accomplish?
Hi, thanks for having me. Sweatpals is the only fitness app on the market today where it's not about reps or calories, it's about people. And so we are a marketplace for in real life fitness experiences and what we call day life, which is people meeting over wellness, meeting over a run, meeting over sweating versus meeting over drinks and nightlife. And on one side of the marketplace, hosts can run their businesses and fitness experiences. And on the other side is how people discover their city's day life.
Interesting. And so, I mean, now that you have this funding in place, what are your ambitions as you look into 2026? As the graphic just showed, you're currently having a presence in about 24 cities. But as you look for expansion, where else in the country makes sense?
So out of those 24, there are really only 5 that we really focused on, and the network is really, really dense. So we want all of those that people have organically started using Sweatpals to get to that stage. So that would be one of our focuses after this funding. And secondly, it's going to be, we also have released tools for studios and gyms, because in addition to run clubs and cold pine socials and all these other experiences, gyms and studios are also want to build community, and we build the community rails also for those brick and mortar businesses.
And of course, as we talk about this planned expansion, as we talk about this funding, Andrew, this is where you come in, of course, just one of the participants in that latest round. So tell me about A16Z Speedrun. I think a lot of people are familiar, of course, with Andreessen Horowitz proper, but what exactly is A16Z Speedrun interested in, and how does Sweatpals fit into your portfolio?
Yes. Well, the really exciting thing about Sweatpals is I really think of it as the anti-social networking app, because rather than, sort of swiping and scrolling and all the things that we've gotten used to over the last 10 years, this is a product that really gets you, outdoors, meeting people, for real, and something that obviously is so needed, these days. And so A16Z Speedrun is a brand new program we're operating at the firm to partner with founders like Salar at the very, very beginning of their companies. And so we invest up to, $1 million when the companies are just ideas, when they're just, a couple scratches on a napkin. And we try to help them, build the company, get it off the ground, started, and then, over time, introduce them to other investors, invest more ourselves, and everything else. And Sweatpals is an awesome example of exactly what we're looking for.
That's really interesting that, you start at the very beginning, contributing up to $1 million. I mean, what does the relationship look like beyond that? As, you meet folks such as Salar and their companies, talk to us about how that relationship develops as, of course, they become bigger and they need more funding.
Yes, absolutely. I mean, I think, founders that are great at starting their companies often want a lot of help once they're scaling to think about, how do I grow my business to to global and international markets? How do I hire, all my top executives? How do I hire, hundreds and then eventually thousands of people? And I think this is where Andreessen Horowitz is really able to step in and provide a whole team around Salar and the Sweatpals team to be able to advise them on everything from exactly that inception from the very, very beginning on a napkin, all the way to one day when they want to be a public company and operate out at a global scale.
And Salar, I think it's interesting that, if you take a look at your press release, in the second paragraph, it's highlighted the fact that only 54% of adults right now drink alcohol. That is the lowest rate ever recorded, which is stunning. And there's a few different ways I can take this. But when it comes to Sweatpals specifically, I mean, why highlight that fact in particular? How does that sort of feed into the environment in which Sweatpals operates?
Definitely. Especially since COVID, people's relationship with fitness has really changed, where they are looking at fitness not just as a way to work out, but as a way to meet, as a way to get entertainment, as a way to socialize. And that's one of the reasons that's helping that too, is also people's are much less interested in drinking and they want to get that high through working out and through sweating. And that's one of the great reasons that this movement is going as well as it is. And we want to be the place every in real life workout to be about that you also meet people and you meet over these shared interests.
Yeah, it's fascinating just how sort of societal norms and societal activities are changing. You can see we're showing a really interesting video of people, I suppose, they're exercising. But Andrew, let's talk about that a little bit more. When it comes to the investment in Sweatpals, is it more about capturing some of these societal shifts? Is it about capturing fitness trends? Or what motivated you to look at a company such as Sweatpals?
Yeah, that's right. Well, I think it is certainly incredibly helpful that the consumer trends are all in this direction. You look at the podcasts that people are listening to, the shows that people are watching, and it's all about, longevity. It's all about, all the new ways that science and technology is going to help us live healthier lives. And so you have that very broad consumer trend going. You also have, as I said, sort of feed fatigue, right? Sort of a backlash against social networks, a backlash against online dating apps as well, and sort of a foundational desire for consumers to meet people in a different way. And so when you couple that with a founder like Salar and Mandy and the Sweatpals team really just going right after it, and they were able to prove this in their hometown of Austin, Texas. And so by the time that we met the team, they had already shown that this could work in one city. And one of the great things about that is you can sort of open new cities along the way. And so now they're in a whole bunch of markets, and we hope to eventually put them all over the world.
Well, certainly looking forward to continuing to follow this story. Really thank you to both of you on this Friday afternoon. That is Andrew Chen, general partner over at A16Z Speedrun, and the founder and CEO of Sweatpals, Salar Shahini. Meanwhile, let's take a look at how markets closed out on the day on this very spooky Halloween Friday. You can see it was a green day in markets. It was touch and go for the S&P 500, managing, though, to finish in the green by about 0.3%, closing out a 6th straight month of gains on the S&P 500, driven by what else other than big tech. The Nasdaq 100 higher by about 0.5% on this Friday. Not too much drama, not too much action in your bond market. The 10-year Treasury yield maybe lower by 2 basis points at the moment, but quiet overall. The VIX, meanwhile, up a hair, trading at 17.44. This is The Close on Bloomberg. The rise of the robots is upon us. We're seeing DoorDash do it, and now even restaurateurs are getting into the game. Last week, Romain Bostic and Scarlett Fu spoke with a legend in the space, Michael Chow, now known as M, about his latest venture, bringing robots into the restaurant world after 60 years of running the internationally renowned Mr. Chow. Here's part of that conversation.
Right now, I'm going to my second revolution, as it were. So basically, I influenced all the fine dining throughout the globe. So even today, you go to any fine dining anywhere, you will find Mr. Chow's initial concept DNA there, okay? So 60 years later, I'm visualizing. It's called Mr. Chow Now. And my prediction of vision, within another 50 years, no human going to cook anymore.
Ever?
Ever, so to speak. Wow. Let me give you that one. So like all Chinese things are great. You take the Chinese doctor, they put 3 fingers on your pulse. They know everything about you, your liver, the whole thing. So now the Western technology can do the same thing, similar thing. And so that would be a machine. And another machine comes along and say, oh, what you need to eat is this thing. Another machine say, oh, don't worry, I'm going to cook for you. So eventually eliminate, okay? So the thing with Mr. Chow Now is the beginning of the process of that. I'm going to use stir fry. Stir fry been in China for 2,300 years. Stir fry is a one breath concept. And basically, in all Chinese culture, it's all one breath. In my painting, it's one breath. In Beijing opera, it's one breath. In Bruce Lee, 6 inches, one breath. Mm-hmm. So it's internal and universal at the same time. So I'm talking a lot, but so this would be benefit because I would be taking all the quintessential dishes, preserving it for this launch. Because of COVID, because of the technology, Uber Eats and DoorDash, for instance, they are dealing with $250 billion business, but they're still using. So what I'm launching is to fill the gap of making all this cuisine. And by the way, this robotic stir fry, in now 2,300 years, eliminated now. The machine can do it all better, in some way better than a human. Mm-hmm. So this, what I'm launching is no longer no more chefs, but the intellectual property of the dishes, interpretation, is still maintained in the robotic thing.
Our thanks to restaurateur and artist Michael Chow, now known as M. And from one legendary restaurateur to another, Romain Bostic and I recently met with Eugene Remm. He is the co-founder and partner of Catch Hospitality Group. The entrepreneur discussing his latest restaurant, the 86, and his partnership with Tillman Fertitta on his outlook on the hospitality sector. Here's part of that conversation.
It's the heart in hospitality. So everything we do is to create authentic, community-driven experiences, and that's kind of what we do here. So we think of this like theater, and the food is just one aspect of theater, just like reading the lines is just one aspect of theater. So we think about food as one element, but you have to put it all together, and everyone is a part in your play. So you have your servers, which may be your lead actors, and then you may have some other folks that are involved in it. So that's what creates the experience.
Well, what else stuck out to me when we walked in addition to the decor, was that it's not a very big space. The physical footprint of this restaurant is pretty small. We're at this gorgeous table, but there aren't very many of them, and I wonder how you thought through that.
Well, I think where New York is going, and I think actually where the markets are going, is a simple situation of supply and demand. So limit supply, increase demand, people want to come. As people start eating and changing their styles of eating, and they're only eating between 7 and 8:30, and the shoulder times, the first seating and the third seating, have become so limited, the only way, in my opinion, moving forward is to shrink the supply to increase the demand. And that's why we thought about these places. So when we look at restaurants in New York now, we look for iconic locations that are small in size so that we can create that intimate experience. That kitchen is about 15 feet from here. So this is almost like having dinner in a house.
Hearing you talk about the idea again that scarcity creates value, you want this to feel intimate, like you're eating at home, for example. Has your thinking on that changed when you think about the recipe, if you want to call it that, for creating a restaurant? And like you said, it has to happen organically at some level. But I mean, has your thinking evolved when it comes to that?
So Catch is 15 years old. It was the original one in the meatpacking district. It was 400 seats, 3 different floors, and it was packed wall to wall. And you had people coming at 5 o'clock, you had people coming at 7 o'clock, you had people coming post-concerts at 11 o'clock, and midnight even, to come and dine with us. And that was one model. And we rode that model really well between New York, Los Angeles, Las Vegas, Aspen, and some of these other markets. As the times have shifted, number one, people are drinking way less. Number two, people are much more health conscious. Number three, Ozempic is real and people are not eating as much. So these are all things to take into account. So when you can't win and the supply has been restrained and people do not have the budgets to eat out as often as they used to, the only thing you could do is shrink your footprint. And even at Catch, the original, which is 14 years old, that's what we're doing now. So next year, we're pivoting the 3 floors where we're doing 2 floors as an event space.
When you open a place like this, or the corner store, which has become wildly popular, what's the general time frame that you expect to actually break even, to start turning a profit off of your investment?
Oh, it's a while. I mean, what most restaurateurs forget is they think when they open the door, the money starts coming back in. But the reality is it takes a lot of time to get the systems and process into place. It takes a lot of time to get to full scale. For us, it probably takes 4 to 6 months to get to our full scale, but we're also very conservative. We overstaff in the kitchen, we overstaff in the operations, and that comes at a tremendous cost, which are things that most restaurateurs do not put into their budget when they open. So what I think happened is a lot of places open, they really need the capital, so they press. They press for more covers, they press for less staff, and that is when the quality suffers. And when the quality suffers in those first few months, that is like the birth of a child is the same as the birth of a restaurant, and how you treat that restaurant in those first few months defines the product for the next 30 years. So people do not invest. So I would say it probably takes about 18 months from signing of lease to first dollar down to when you start to see dollars come back, which is a challenge.
So do you get nervous, though, in those first few weeks? I mean, this place has only been open a month and a half or so, a couple months, I believe. I mean, do you get nervous in those first few weeks of, because if something goes wrong, then everybody's going to go and tell their friends, oh, I went to this place and I had a bad experience?
Anyone who tells you they don't get nervous is an absolute liar. So yes, we get nervous, but I will say it's a healthy nervous now. In the past, it was much more catastrophic. So this is my 21st opening of a restaurant in my professional career. So the team that we have, the layers of structure and corporate overhead and the backing from Tillman Fertitta and the Landry's portfolio, that has created us, if I'm on a tightrope, I know I have a net. And that makes for an easier walk on the tightrope. So yes, it's still nerve-wracking. It gets less and less. And when you have a team, it's easier because you know the people are going to do their job. So this has been the best opening I've ever been a part of. The corner store was more nerve-wracking because it was a fully new concept with a fully new team. Now we've taken team members from there and brought them over here. So there's a much greater rhythm, which is why people scale, because you have great people who do great things and they continue to do it.
This might be a good opportunity for folks who aren't familiar with you to just kind of explain where you came from. I mean, you basically started your career more or less in nightclubs, transitioned into restaurants. You and Mark Birnbaum went out on your own, doing your own thing. At some point, I think it was in 2017 or so, you teamed up with Tillman Fertitta. Obviously, that had to have been a big help, at least financially, I would assume.
Now, none of this is possible without the partnership with Tillman Fertitta. His ability to scale, to grow, and have the structures and systems and process in place to create these things. That's the reason most restaurant groups fail, because they actually don't have the systems and process on top of these amazing ideas to do that. So that partnership with him and having him now as a mentor, a partner, and a friend, and just a resource, and his entire organization has been one of the reasons that has catapulted us to grow the way we have.
And our thanks to Eugene Remm, co-founder and partner of Catch Hospitality Group, speaking to Romain and I at his new restaurant, the 86. Now, still ahead, coming up on the close, what investors need to watch for over the next week. This is Bloomberg. All right, it's Friday, so let's look ahead to what else we're watching for over the next week. We kick off on Sunday. That's when OPEC and its allies meet, and we get a clock change here in the U.S. I believe that means we gain an hour of sleep, so I'm quite excited for that. Monday, that brings us to Monday. We're going to hear from Fed Governor Lisa Cook. She speaks in her first public remarks since the Supreme Court put arguments for her lawsuit on hold until January. We also get earnings from Palantir. That brings us to Tuesday. Big elections here in New York City, New Jersey, and Virginia. We'll have full coverage of that. And then on Wednesday, we'll get private sector jobs data from ADP, more earnings, this time from Qualcomm's, McDonald's, Lucid, the list goes on. You go ahead to Thursday. That's when Tesla shareholders will vote. It's their annual meeting, and they're going to vote on that proposed $1 trillion pay package for Elon Musk. More earnings as well. And then you get to Friday. 1 week from today, we get University of Michigan consumer sentiment and more earnings from Wendy's, KKR, and Constellation. That does it for the close on this Friday, though. Balance of Power is up next. Happy Halloween.